get my recording going, and then I'll share my screen, and then we'll jump into the contract. All right, so we'll start here with the residential purchase agreement and the finance section. So first page has all the meat, as you guys know, the first year's description of the property, and then you get into agency, which is also important because without agency, we don't get paid. So we've got to get all that part right. But then this is kind of what determines whether or not your offer is going to get accepted, right? So I felt we should talk more about these finance terms and dig into how it all works and comes together. So the first thing on the finance terms is that the buyer represents that the funds will be good when deposited with the escrow holder. So it's important because the deposit, the fact that it's a good deposit is not a contingency. You are saying upfront that when you turn over that personal check or cashier's check, that those are good funds when they hit the escrow company. So, I remember a long time ago, people used to write a check and then go and try to put the funds in for that check. But you're saying at that point, you have the cash and those funds are good. And it's always a good practice that even before you agree to accept an offer, that you verify proof of funds, that you verify that the buyer does actually have those funds available. And you can do that by seeing a bank statement or some other financial statement that shows that the buyer has access to those funds and those funds are associated with that particular buyer, right? That you're not waiting for someone else to give the buyer the cash. It can be a little sticky if you're dealing with an gift letter situation, because if the buyer is getting a gift from a family member, then you don't want to mix the funds and you don't want to have the buyer take the funds out of that person's account too soon and move them over. But it's definitely something to consider. If your buyer, I always say, you should never discriminate unless it's for financial reasons, right? So the only reason that you would want to discriminate against buyers if they don't have enough money to be able to, one, purchase the property, make the down payment, have a hefty deposit, and then actually have enough cash in case something goes wrong, right? Oftentimes in our escrows, different things come up. We want to make sure that the buyer has enough cash to cover situations where they may need to infuse some cash into the situation. Maybe the appraisal falls short, or maybe there are repairs that need to be done, or maybe closing costs is higher than anticipated, rates go up. There's so many different things that can happen throughout the transaction. So qualifying a buyer and making sure that they have enough cash on hand to be able to see their way through the end of the transaction is really, really important. So I hope that you all are getting proof of funds, providing proof of funds, and then verifying that they have more than just enough to squeak by, right? You want to see that they have a good amount of money in their account so that if something comes up, they can handle it. Obviously, there are going to be some situations where people are just squeaking by. But again, if you have the opportunity where you have two offers and they're similar and one has more money available, it's probably a good idea to look to the person who has more cash available, because the risk of them not being able to follow through the transaction is lower than a person who doesn't have enough cash. So sad, but when we're representing our sellers, we want to make sure that the deal closes and that we take good care of our sellers. And if we're working with a buyer and they have very little funds, then it may be important to let that buyer know, hey, what else can you do to make sure that you have more money? Or do we need to wait and allow you to have more time so that you can save up a bit more money? Especially in this super competitive market, is it fair to drag a buyer around that doesn't have enough cash and just have them have one disappointment after another? Or should that buyer maybe take a minute, save up a little bit more money, come back in the next 30 days or so when they can have a more competitive situation? So the first thing, again, is we're talking about the initial deposit. Folks have been around in the business for a long time, still refer to it as EMD, which is earnest money deposit, but it's actually been renamed initial deposit. Whether you call it EMD or initial deposit, we're still talking about the same thing. What is the buyer putting up to let the seller know that they're serious about this offer? because as you guys know, when the seller accepts the buyer's offer, then all the power shifts to that buyer. And that buyer has now the ability to do their inspections, whether they've removed contingencies or not, they still have an opportunity to make a determination as to whether or not they want to follow through on the escrow. And that money that's held in deposit is letting the seller know that this person is, one, serious, and they're willing to put up some money, and two, again, that they have cash and the ability to put up some money. So the contract says, how are they going to get this money to escrow? And they have 3 business days. Now, as far as I know, this is the only reference to business days in the contract. Everything else is calendar days. But when it comes to getting the deposit to escrow, you have 3 business days to get that money in. You can either send it through electronic funds, which is a wire, which is great, except for all that wire fraud that's going on out there, right? You got to be super duper careful that if you're wiring funds to anywhere, that you have the right account that you're wiring it to, and you want to follow all those safety procedures and make sure they're connected with the escrow company and they're only taking direction and information direct from the escrow officer over the phone, not by email. Oftentimes people are electing to bring in a check, and that can be a cashier's check or a personal check. I personally would not be okay taking a personal check from someone. I would want to see a cashier's check. It's not up to me though, it's up to the seller. But if I'm advising a buyer and they're putting together an offer, I would say, hey, I think the seller might really want to see a cashier's check over a personal check. It might cost them $5 at their bank to pay for a cashier's check, but in a competitive market, I think it's worth the $5 and the hassle to go down to your bank and get the cashier's check. They can do a personal check if they check that box and indicate that that is what they're going to do. And it takes about 10 days for that check to clear. So you're going to verify that the check has been deposited to escrow and escrow has received it. But then you need to check back in about 10 days to make sure that that check actually cleared. So, and then now lately I've been seeing this weird thing where people are checking the box other and saying buyer's choice. Yeah, it's the buyer's choice, but they make the choice up front. They don't make the choice later, right? So they make the choice up front. They decide wire, cashier's check, personal check, or maybe a bag of money. But you don't put buyer's choice as if they're going to make that decision sometime later on. The seller needs to know how that money is getting to escrow, and they make their decision whether or not they feel secure with that method because it's decided up front. And it's this weird thing that I've been seeing now in almost every offer. They're checking the box and saying buyer's choice. Don't do that. If for some reason, some really odd, bizarre, crazy reason, they're giving the check to you, which they shouldn't, it should go direct to escrow, then you would check that or to box, and you would have to fill that out and follow up with all of the ton of paperwork that you would have to deal with for that. I don't recommend that you guys ever do that, so I'm not going to get into that or talk about that at all. Just have them send the check direct to escrow. There's almost no reason that you should ever get your hot little hands on that check or any other cash for the transaction. All of that should go direct from the client to whoever they're paying, escrow company, home inspector, whoever. Cash goes direct. We don't touch that money. We don't touch the check. We don't get involved. Sometimes there's an increased deposit. They want to, after some other period of time, increase the deposit. Perhaps after inspections, they would increase the deposit, or some other thing, they would increase the deposit. I've never really saw a reason to do it that way. The whole point of the deposit is to ensure that the buyer is serious and they have cash now. If you increase the deposit after you remove contingencies, I don't get it as much, but you do have the ability to do that. And in order to make that part of the liquidated damages, meaning the seller to actually hold on to that money, if the buyer defaulted after removing all contingencies, then you would need to use the RID form, it's lunchtime, which is the release of increased deposit. That's another one that we don't see too often, so I don't want to spend too much time on that. Then we get down to number C under finance terms, which is an all cash offer. Woohoo! We usually really love seeing all cash offer. Whenever we can cut out lenders, we love it. We love our lenders, but we also love to cut them out of the process if at all possible. So where it says all cash offer, when you check that box, it will eliminate you from being able to check any of the boxes associated with loan. However, it does not eliminate you from being able to check the appraisal contingency box. So just keep that in mind. You can still have an appraisal contingency, but you won't have any of the other stuff under D, loan. So if there's an all cash offer, that means no loan is needed to purchase the property. It is not contingent on the buyer obtaining a loan, and you're going to provide written verification that the buyer has the cash to purchase the property now, today. There is an option that the buyer can show that within 3 days, but as you guys know, if the buyer has the cash in 3 days, they can buy it in 3 days. If they don't have the cash today, they shouldn't be making an offer for cash they don't have today. I don't know if you guys are as old as me. There used to be like this show called Popeye, and this guy named Wimpy would always ask Popeye if he could have a hamburger today and pay on Tuesday. And Popeye didn't go for it, and you shouldn't either. So I believe that the proof of funds should be with the offer, right? Doesn't mean you have to do everything the way I say it, but if I'm going to take my seller's home off the market and not take any offers from anyone else and accept this buyer and then wait at the whims of this buyer, I want to make sure that the funds have been verified before I take the property off the market. So I want to see that verification or proof of funds before I accept the offer, not within 3 days after acceptance. Just me. And then let's say we don't have an all cash offer and we do have to work with that lender. And hopefully we have a very good lender, but then we would be dealing with a loan. So let's dig into what happens when we're dealing with actually having to finance the property with a loan. So the first thing we want to do is figure out, well, how much are you actually financing? What's the financed amount? We know what you're purchasing. How much are you financing? And that's a big, important piece to determining whether your offer is actually going to be a solid offer or not. Now, you can buy a home at 100%, and VA offers are great, and people are able to do that. Where the risk comes in these days is when you know that properties are appreciating so quickly and the appraised value might not meet there. And so that's why we're always hoping that people have a lot of money down, because if they have a lot of money down and the property doesn't appraise, then they can take some of that cash down and move that around to cover the difference between the purchase price and the appraised value. And most of the time, if you're dealing with a government finance loan, it's going to be a little bit more difficult to get the property to appraise in a market like the one that we're in now that's appreciating so quickly. Just the appraisal process is more stringent for the government programs than it is for the conventional loans. There's less flexibility on the government programs than there are in the conventional loans. So I was just meeting with an agent and she was like, oh my God, the math. And I'm like, what math? Well, here's the math of the contract. So when you're talking about figuring out the first loan amount, you're going to take the down payment and subtract that from the purchase price, and that's going to be your loan amount. So you got 100% of the purchase price, and then you take whatever the percentage is of the down payment and subtract that. Then you take that number and multiply it by the purchase price. So for instance, if I'm working with an FHA buyer and they have 3.5% down, then I'll take 3.5% minus 100%. That gives me 96.5%. And I'll take 96.5% and multiply that times my purchase price. That is the math. That's all the math you need for real estate in terms of writing an offer, right? That and maybe calculating how much deposit you should recommend your client to put down, because usually we say, oh, about 2% or no more than 3%. They might have to do a little bit of math there. So your first loan amount is going to be what you're financing, so the purchase price minus the down payment, and you'll put that on that first line. And then you need to tell the seller what type of financing. They are going to assume it's conventional unless you indicate otherwise. So it could be FHA, it could be a VA loan, it could be seller financing or assumed financing, which I haven't seen that since I've been in business, but I don't know. I don't count anything out these days. Things are crazy. That may come back in some kind of crazy way. Who knows? So let's talk a little bit about FHA financing. So FHA financing right now in the hierarchy of things, I think is on the bottom rung of everything. And it's super sad and unfortunate. I see so many FHA offers where the buyers are writing these way over asking offers and still not getting anywhere. You've got your cash, your conventional, VA, and then your FHA offers, right? And why are FHA offers so much less desirable than a conventional offer? Again, there's less flexibility. Sometimes the FHA appraiser will go in and call out things such as dry rot, and those things will then have to be repaired prior to closing. The other thing is the appraisal actually lives with the property for 6 months. So you can't just go in and get a new FHA appraisal if the property doesn't appraise. If you're doing conventional financing and it's just like a disaster, you can say, you know what, I'm going to leave this lender, get a new lender, get a whole new appraisal. Your FHA, you cannot do that. Once that FHA appraisal is in, it's in, and it lives for 6 months. Now take a minute to think about that. 6 months in this market, an appraisal living for 6 months when our properties are appreciating like literally every 2 weeks, pretty rough, right? So most sellers and listing agents, if they've got a series of offers and one of them's FHA, unfortunately that FHA offer is going to be at the bottom of the pile. So if it's at all possible for your FHA buyer to qualify under a conventional financing, definitely have them look to see if they can qualify for conventional financing. Usually the reasons that a buyer has to go FHA is going to be like if they have a foreclosure or a bankruptcy or something like that in their last 7 years, or a short sale in the last 4 years. But the biggest reason usually is their debt to income ratio, meaning the amount of money they make versus how much they're paying once they purchase the property and they have to pay taxes, insurance, and all of their other bills, right? So if a person isn't making a lot of money and they're using the majority of their income to afford the home, that means they're going to have a high debt to income ratio. FHA allows that person to spend up to 60% of their income on their housing, whereas conventional is closer to 45. So it's tougher for a person who's not making a lot of money to qualify for more under conventional, but when they go FHA, they're almost eliminated from even being able to make an offer. So something that they have to think about, like, do I go conventional and I qualify for a lot less? Or do I go for FHA, I qualify for more, but nobody wants to accept any of my offers? It's a tough one. It's a tough call. It's a tough position for an FHA buyer to be in. VA, I think, is a little bit higher than the FHA on the rank one because people want to work with veterans at times and they will take more of a risk with a veteran. You still have the same conservative appraisal issue to contend with. Also, because VA is 100% financing, I think that maybe the VA buyer may be may have more cash, but they're choosing to use VA because it's a more affordable loan. So they're not locked into that process and they might have more wiggle room. I'm just making generalizations. I don't know for sure. I'm just throwing things out there that seem to make sense to me. And then the other thing with VA that's more of a myth now is that you have to have a clear pest report. In actuality, you don't have to have a clear pest report. The guideline is that there is no active infestation, meaning there are no termites, beetles, whatever, in the property. So when you get a pest inspection, it doesn't just speak to whether or not there are termites, beetle, active infestation. It also speaks to things like dry rot and earth to wood contact and other things that are not active infestation. And so most pest reports can have many things on there about wood destroying pest. It falls under that category. Dry rot falls under that category, but it's not a active infestation. There's a form, I think it's called like the NP3W299. I made up most of that. But anyway, there is a form, and I can bring it up and show it to you guys. And it allows the pest inspector to just certify that there's no active infestation. And that is enough to cover the VA guideline. You do not have to have a clear pest on a VA. A lot of agents still have not heard the news about that. So sometimes there's a little bit of education required to make sure that they understand that. So if you are representing a VA buyer and you're submitting your offer, it may be worth the additional time to explain to the listing agent, hey, and by the way, want to let you know that we do not have to have a clear pest, just have to show that there's no active infestation. And hey, let me show you this form. And did you know? And hey, this can save you later on along the way. Make a friend. And then, when they are submitting your offer to the seller, they're not going to say, hey, you don't want to take this VA offer because it's going to require us to provide a clear pest. And that's actually not the case. So VA is actually considered conventional financing, but it is an assistant program that allows the the buyer to be able to use 100% financing and to not have to have mortgage insurance. So that's a super awesome product for veterans that is available for them. But again, oftentimes it falls lower on the hierarchy. A couple of other things to consider about the FHA and VA financing. FHA and VA financing also require the FHA amendatory clause. And so I'm skipping around and I'm jumping down now to 3D3, which says FHA/VA. There are two forms that are required, the FVA and the FHA amendatory clause. Let's look at the FHA amendatory clause first. Now, this is an interesting document because gone back and forth with this a bunch of times. And to me, it reads that the buyer does not have to buy the property if it does not appraise. And so you might say to yourself, okay, that makes sense, no big deal. Well, what if the buyer removes the appraisal contingency, but then they also have the FHA VA amendatory clause, which says they don't have to buy the property if it doesn't appraise? Doesn't that actually throw that contingency back in by saying they don't have to buy it if it doesn't appraise, meaning they should get their deposit back and they should be able to get out of the escrow? So there's even if a VA buyer or FHA buyer removes their appraisal contingency, they actually still really have their appraisal contingency because they can't be made to purchase the property if it doesn't appraise. They can, if they choose to, purchase the property if it doesn't appraise, and they can pay an additional amount out of their own pocket to cover any difference, but they don't have to. And so it's just something that a seller should think about when accepting an offer from a VA or FHA buyer, that they will automatically have that out. Now, some argue that it is this number that you put in here, and that you could put in a larger amount. Because it says here, let's read it. It is expressly agreed, notwithstanding any other provisions in this contract, the purchaser shall not be obligated to complete the purchase of the property described herein, or to incur any penalty by forfeiture of the earnest money deposits, or otherwise, unless the purchaser has been given, in accordance with the HUD, FHA, or VA requirements, a written statement by the Federal Housing Commissioner Department or a direct endorsement lender setting forth the appraised value of the property not less than. So you can put a different number in there. So that's an interesting thing that I didn't think about before. So basically, let's break this down a little bit. So it's expressly agreed that the purchaser is not obligated to complete the purchase and cannot incur any penalty unless they get a statement from the Federal Housing Commissioner that the appraised value of the property is not less than. So most of the time we think we put in the purchase price there. But what if you put in something less than the purchase price because you know that you're going to have to make up the difference? What if the buyer is more than willing to make up the difference and they offered $500,000, but they know this thing is only going to appraise for $480,000. So instead of putting $500,000, they put in $480,000. That way, they are saying that if it appraises for $480,000, they're going to bring in the difference between the $480,000 and the $500,000. So that's kind of a different way to look at this form that I hadn't seen a couple of years ago when I looked at it. The purchasers, wow, I cannot talk today. The purchaser shall have the privilege and option of proceeding with the consummation of the contract without regard to the amount of the appraised valuation. So they can choose to purchase it if they want, but they are not obligated. The appraised valuation is arrived at to determine the maximum mortgage the Department of Housing and Urban Development will insure and will guarantee. Neither HUD or VA warrant the value or the condition of the property. The purchaser should satisfy himself or herself that the price and condition of the property are acceptable. If after signing this amendatory clause, the purchase price increases, buyer or seller agree to sign before close of escrow a new amendatory clause that reflects the final purchase price agreed to by the buyer or seller. Well, that's interesting because it says it has to reflect the final purchase price agreed to by the buyer or seller. So that throws out that other thing where you could put in a different amount. I don't know, guys. It's just what it is. It just is what it is. They have to, the house has to appraise or they don't have to buy it. For FHA transactions, the amendatory clause is not required on HUD REO sales, sales where the seller is a Fannie Mae, Freddie Mac, rural housing, blah, 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 or sellers at foreclosure sales, those who are the borrower will not be owner occupant. So if it's a foreclosure, an FHA foreclosure, then it doesn't apply. But if they're purchasing it from any old seller, then the amendatory clause is in effect. The undersigned buyer and seller and real estate agent hereby certify that the terms and conditions of the sales contract referenced above are true to the best of their knowledge and belief, and that any other agreement entered into this by any parties in connection with real estate transaction. So that's interesting. So I had an agent who called me the other day and he brought up the fact that, hey, why don't I put another amount in that box? And I didn't read all the other paragraphs and I go, oh, maybe you could. But then after reading the entire thing, I go back to my original statement, which is if the house doesn't appraise, then they do not have to buy it. And the seller cannot keep the buyer's deposit. So that means that even if they remove the appraisal contingency, they still have an out with this FHA amendatory clause. I know I said a lot and might have confused you guys. Any questions on that? Okay. Here's the other FHA VA notice and addendum. And this one is basically just saying if there are things that are required by FHA or VA that the seller may not know about going into it, but they need to know, they have 17 days to get this out, which is interesting because, for instance, if the seller is forced to pay certain fees or the buyer can't pay certain fees, it's better that they know that at the time of offer, but they get 17 days to get this back to the seller. So the buyer requests that the seller pay the following. And it used to be, a lot of these things have changed over time. It used to be that the seller had to pay the title and escrow fee. But I guess it's really just that the buyer can't pay title and escrow fee, which, whatever. And the buyer requests that the seller make any repairs. So this would be where if you wanted to say that they make sure there's no active infestation in the property, right? We talked about that on VA loans and FHA loans. You just have to show that there's no active infestation. You don't actually have to have a clear pest, but you could put that on there that, to provide a report stating there's no active infestation. Or if you wanted them to have a clear pest, you could put that on there. And then the seller can respond to the request. And if the seller doesn't agree, then the buyer has to figure out how they're going to get these requirements handled, right? And so it could be sometimes the lender will give the buyer a credit that can cover some of the cost, or sometimes the agents step in and cover some of the costs to make ends meet. But again, you guys can see how in a competitive market, when there's additional rules and guidelines and things that the seller has to pay and the buyer can't pay, it makes the FHA or VA offer a little less attractive because there's more hoops and more requirements in the process. Whereas when you're dealing with conventional, it's kind of easy peasy, whatever you can work out. Under first loan, let me get back up here. You want to make sure that you always put something in where it says rate not to exceed. Right here, I have 3.5. You want to think about whatever the buyer's interest rate is, build in a little bit of cushion, and then put a cap. That cap allows you to use your loan contingency. Without a cap, it's kind of hard for you to say, well, the buyer didn't qualify for the loan. Well, the loan at what rate? So you always want to put a rate there. So that allows you to use your loan contingency. And if the buyer's willing to pay points, so we usually say, okay, if going rates are 3.25, we'll go 3.5, and then the buyer's willing to pay up to 1 point to make all of that work and come together. Additional financing terms, that's where in a whole different market and a different world, a buyer could potentially ask for a closing cost credit. They could put something there like they're going to pay for something. They could say that they're willing to make up the difference on the appraised value. Lots of different things can go under additional finance terms. The language that we see most often when we're talking about a credit for closing costs is seller to credit buyer X amount for buyer's total closing costs. And the reason we want to say total closing costs is because there's a such thing as recurring closing costs and non-recurring. So your recurring closing costs are going to be things like insurance, mortgage payments, things that your buyer's going to continue to pay even after the close of the transaction. And then there are going to be costs that are only associated with this transaction. So for instance, like the recording fee or the lender fees, those things don't occur again, or they don't reoccur. And so those are your non-recurring closing costs. Unfortunately, if you don't specify recurring and non-recurring or total closing costs, then it can be interpreted that you were only speaking to non-recurring closing costs, and you could potentially be leaving money on the table. Let's say if you got a credit for 3%, but your non-recurring cost only came up to 2.5%, that 5% just goes back to the seller. It's like no change back, right? So you want to make sure that you can use up as much of the money as you possibly can. Oftentimes when we leave money on the table, we'll do things like buy down the rate or use up the money in other ways as much as possible. So be careful not to over ask for credits, to kind of have an idea of what the buyer's closing cost is going to be, before you go in and ask for more credit than what the buyer needs, because they're going to end up leaving that money on the table and it just goes back to the seller. Fortunately, CAR does the math for us, and we'll put the balance of the down payment and purchase price here, and then the purchase price total goes here. Everybody signs at the bottom, just as they do on every page, and then we're over to the next page to finish out the finance terms. So we're still under section 3, finance terms. We're just going down the alphabet. We're A, B, C, D, E, F, G, and we find ourselves on H. Now, I've already talked a lot about verification of down payment and closing costs. I've already talked about making sure that you have that verified, and that if you're representing a seller, you're going to make sure those funds are there and verified. If you've got a really good lender, they're going to include that in their pre-approval letter to say that they verified the buyer has the funds for down payment and closing costs. And if you're using a template, I recommend having this box checked, verification attached, because again, I don't want to find out 3 days after I've already taken my house off the market that your client doesn't have the funds available to close the deal. I want to know before I accept the offer that the funds are available and in the client's name, or whatever the situation is. So when you're writing a good, strong offer, you're always going to have proof of funds submitted with your offer if you're doing financing, right? And so if you're financing, you want to either have your lender make it part of the pre-approval letter saying that they verified it, or you want to have that bank account, bank statement, something that says that you can prove that the funds are there. Appraisal contingency and removal. This agreement is contingent on the written appraisal. If it is not, you want to check the box is not. I do want to remind you guys that if it's an all cash offer and you select all cash, you still need to come over here and check the box that says it's not contingent on a written appraisal. That doesn't automatically happen. So if you don't want there to be an appraisal contingency, make sure to come back and check the box that it's not contingent. Otherwise, it is contingent on the appraisal. And then remember, we talked all about that amendatory clause for FHA and VA buyers, that even if you do remove the appraisal contingency, they still have an out because of the FHA amendatory clause. It gives you 17 days to get the appraisal back in and completed. But if you think you need more time, you can extend it. I don't necessarily recommend shortening the time right now because we have very little control over how long it takes to get an appraisal. People are doing it and just crossing their fingers and hoping for the best. But mostly what we're seeing right now is folks just eliminating the appraisal contingency altogether because the buyer has the cash to make up the difference. And so they're willing to do that. So they just get rid of the appraisal contingency altogether. Do remember that the buyer is not necessarily bringing in additional funds. Depending on how much money they have as their down payment, they might just be restructuring their loan to value. So the property was going to be $500,000. They were going to put $100,000 down. Now the property only appraises for $480,000. So instead, they're only putting $80,000 down. And that 20% is going to make the difference in the value, but they're still having the same amount of cash come out. It's just their loan to value is different. So they have basically less equity in the home when they purchase it. Loan terms. So loan application within 3 days. Ha, 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 right? Again, I'm not going to take my property off the market unless you can already prove to me that your buyer is pre-approved, right? You have been pre-approved to purchase the property. Now, there's different degrees to pre-approval. I would like to see that the buyer has cleared underwriting, right? And the only conditions are maybe the prelim, and hey, sometimes there's even an appraisal waiver. So you want to highlight if your buyer has more if your buyer is more pre-approved, let's say they're further through the process, they've cleared underwriting, you want to make sure that the seller knows that, because some finance deals can be almost as good as cash if the buyer has made it all the way through underwriting and all we're looking at is the prelim, and I'm competing with a cash offer and I am maybe higher than a cash offer, then maybe it makes more sense to go with me than a cash offer because my buyer's made it all the way through underwriting. There are not going to be any guesses or pop-ups, and if there's no appraisal contingency, then I'm just as good as cash, right? So it makes sense to take the time to make sure your buyer's all the way through the underwriting process before they get out in the market and start trying to be competitive when they're up against cash offers. If your pre-approval is attached, you want to make sure to check that box that says letter attached. And again, if you're working with a template, which I hope all of you are, go ahead and check that box in your template so it's just always there and always checked for you. You do have a loan contingency. It defaults to 21 days. Oftentimes, we like to move that down to a shorter time frame so the seller doesn't have to worry or be on the hook. This has been coming up lately with loan contingency. It doesn't mean that your loan is funded when you remove the contingency. Some buyers are like not wanting to remove their loan contingency until their loan is funded. The loan contingency is there for the buyer to get far enough into the loan process that they feel confident enough that they can remove the contingency. It shouldn't be like when the loan is funded. It should be when they've cleared underwriting and they've met all of their conditions. That's when they're thinking of removing that contingency. And so a lot of times when we see delays with buyers not wanting to remove the loan contingency, it's because the expectation has not properly been set as to what that means to removing the loan contingency, right? Once the conditions have been met and they have clear to close, then they should feel comfortable removing their loan contingency. That's the point, so that the seller can then say, all right, now you're fully vested, Mr. Buyer or Mrs. Buyer or they buyer, and we can take whatever steps we need to take to ensure that this transaction is going to go through. It's not really fair for the buyer to hang on until the loan is funded and kind of leave the seller just hanging out there, right? So remember, stay in touch with your lender and follow that condition process, right? Where are they with the conditions? The lender may not out and out tell the buyer you can remove contingencies, but the buyer can ask questions like, well, have I met all the conditions? Is there any conditions out there that you think are going to be a problem? Or is everything kind of like easy peasy stuff? So that will let the buyer know that when it's ready to remove contingencies. Sometimes we don't need a loan contingency and maybe they're already through underwriting and everything's in and they can say, you know what, I can purchase this without a loan contingency because I've done all my homework and upfront work and I'm ready to go and I don't need a loan contingency. Then you're almost as good as cash, right? Because you've got no loan contingency. I'm almost out of time and I do want to talk about lender limits on buyer credits. So let me just start by reading this and then we'll kind of dig into teasing it out. So any credits to the buyer from any source for closing or other costs that is agreed to by the parties, they call that contractual credit. So, hey, can you pay me because I need closing cost credit? Or, hey, there was something wrong with the way you put the bathroom together. I want a credit for it because I don't want you fixing it. I don't trust any of the work you do. Just give me a credit for it. Or, hey, I really love the furniture. I want, whatever the situation is, if there are credits being given, sometimes the lender gives credits. Sometimes we as agents find reasons that we need to give credits. All of the credits that are agreed to are considered contractual credits. But every loan program has what's called the lender allowable credit. So every loan program, they only allow the buyer to get so much in credit because they want to make sure that the buyer is fully vested in the property and that the buyer is not necessarily getting paid to buy the property like we had back in 05 and 06 where people were buying properties and coming out with cash in hand. And so the contractual credit can never be more than the allowable credit. That makes sense, right? You can't be getting more money than you're allowed to get per the loan program. So how do you work it out if your contractual credit is more than your allowable credit? Well, you can't get that credit, right? You can only get the allowable credit. It doesn't mean that the seller is going to reduce the price. And it doesn't mean that they're going to give you a check outside of closing. None of those things are going to happen. So just make sure that you are structuring any credits that you're asking for or getting so that they fall within the allowable credit limit, because anything over that, you're just not going to get it. It's lender fraud, and you shouldn't be trying to figure out a way to get them paid after closing or any of those other kind of things that are not allowed. There are some things where, like, perhaps rather than giving the buyer credit, the seller pays a contractor or repair person directly. Then that's not a credit to the buyer. That's a person being paid to do work on the property. But any like cash to the buyer has to be limited to what that loan program allows, which is known as the lender allowable credit. So be aware of that. And then buyer stated financing. So the seller is relying on the buyer's representation or type of financing specified. We might see this again. We saw this like last time the market went crazy. People who were like FHA buyers, they were like, you know what, if I put that I'm an FHA buyer, I'm never going to get my house financed. And so they were cash, right? Because only cash offers were winning. And so they were like, you know what, I'm just going to say I'm a cash offer. And once I get accepted and I'm in escrow, then they'll just have to deal with me. So that's when this little section got put into the contract. So the seller's relying on the buyer's representation, type of financing specified, including but not limited to how much cash, right? How much your down payment is, contingent or not contingent loans. So is it really cash? Is it really contingent on you needing a loan, or do you not need a loan? Do you really need to sell your house? Or maybe you don't need to sell your house. So you shouldn't really say, I don't need to sell my house, but you're really hoping, you're crossing your fingers, toes, and eyes and saying, I do need to sell my house, but I don't want to tell you that because you'll never accept my offer if I do, right? So the seller has agreed to a specific closing date, a purchase price, and to sell the buyer in reliance on the buyer's covenant concerning that financing, right? They chose your offer because you said you didn't need to sell your house. The buyer shall pursue the financing specified in the agreement. The seller has no obligation to cooperate with the buyer's efforts to obtain any financing other than that specified in the agreement, and the availability of any such alternate financing does not excuse the buyer from the obligation to purchase the property and close escrow as specified in this agreement. So it's basically telling the buyer, if you say you're going to do it, you need to do it. Now, sometimes buyers may try to change financing terms and get things done. And in the end, if they can do it without the seller knowing or having any part in it, they could get away with it. But if they can't pull it off, let's say they said they don't need a loan, and then they try to go and get a loan, and then they can't get a loan, they can't use that as a reason to cancel the transaction, or they can't use that as a reason to get an extension. Well, I need an extension because I need more time for financing. What do you mean? You're all cash. Well, I need an extension because my house hasn't sold yet. This isn't contingent on you selling a house. So the buyer really needs to come forward with what they really have in hand, because that's what the seller relied on to make the decision to choose that offer. So that's the buyer stated financing. And that is all of the loan portion or the financing terms portion of the purchase agreement. Any questions on all of that I talked about for the last 51 minutes?
I do. Hi, Talisa.
Hi, Nikki.
So I think I asked this before on something slightly different, but going back to item K, for example, buyer stated financing, if they kind of come back and say, oh, whoops, I don't have the cash after all, I've got to get a loan, or we find out because they've asked for an extension, and the seller says no, I'm just gonna, I can put it back on and get a cash offer tomorrow. What the buyer is risking is their earnest money deposit. But as we talked about before, they both have to sign off on it, right? So it seems like they still have the power.
They can probably get away with it. So what happens, let's say the buyer has the opportunity. This is like a legitimate way that it normally happens. Let's say they are planning on getting a conventional loan. And then somebody comes and says, you know what, you can get a VA loan and put no money down. And they go, what? I'm going to go VA, right? And they don't say anything to the seller. And then they find out, in order to get a VA loan, you need a 2-week extension. And they go to the seller and say, I need a 2-week extension in order to be able to get this VA loan. And the seller says, no, I'm not going to give you an extension. In fact, here's a notice to perform. You need to remove your contingencies in 2 days or I'm going to cancel. If they don't remove their contingencies, then the seller cancels and they walk away with their deposit.
So who walks away with the deposit?
The buyer keeps their deposit. As long as they didn't remove all contingencies, they get their deposit. Now, of course, the deposit sits in escrow until both of them sign off. But according to the contract, the deposit goes back to the buyer as long as they never removed contingencies.
Got it. Okay.
So people still do it and they still try to get away with it. And, they end up getting caught because delays happen. And they need to ask for something. And it usually comes back and bites them in the butt. But if there was a way for them to switch their financing midstream and the seller never knew about it, they could potentially get away with it. Nicole?
Yes, I have a different question about the deposit. So I always tell the buyer that the deposit is typically between 1% and 3% of the purchase price, but if they make a deposit of over $10,000, that they're no longer in small claims court. In this market, $10,000 doesn't cut it anymore. So what are the ramifications if something happens and that deposit is on the line? It just goes to 21B and 22B and regarding, arbitration and so forth, which would be the case for under 10,000 as well. So how would you present this to the buyer?
I think, I'm not 100% sure, I'll check, but I think the limit of $10,000 for small claims court I think it's more than 10,000 now, but I'm not 100% sure. So I need to find out. Most of the time, before you go to small claims court, they work it out. Most of the time, you've got a deposit in escrow. We end up negotiating that deposit for them, and they get some portion of it back, and the other party keeps some portion of it. But if they over $10,000, the first step is mediation. According to the contract, mediation is not optional. It is a required first step. And so they would have to do that and pay for mediation. So usually before somebody's willing to go through the step of mediation, they'll just negotiate amongst themselves and figure it out, split it down the middle, whatever the case is going to be, because I think mediation in and of itself is like $5,000 or something. So.
Thank you.
But I don't have a clear-cut answer for you. Nikki, did I answer your question enough on the buyer stated financing?
I think so. It's just kind of an ongoing concern about disposition of that earnest money if something goes wrong. It just seems to me it's just so murky.
It is very murky. And so the best thing that we can do to protect our clients is, like I'm saying, is really verifying those funds, right? Seeing if they have cash, because, cash solves all problems, if they have, if they're saying they're going to buy the property and they don't need a loan, and you see they have the cash to buy the property, then if they do try to get a loan and something happens and they can't move forward on the loan, then they still have the cash to make it happen. you only run into issues when they don't actually have the cash to close. If they say they're putting 20% down and they actually have the 20% to put down, even if they try to put less down, they can still come back and put the money down. So verifying that they have the money is one of the best things you can do to try to ensure that your deal holds together. But you're right, that deposit money is as murky as it gets.
Okay, that makes sense. I guess the other thing is something that you mentioned is, if they say they're not contingent on their house selling, but they really are.
Yeah, and then the only way to solve that as well is to verify that they have the funds. So how are you purchasing the property if if you don't have enough cash and you don't qualify for a loan? So we just have to do our homework and just check, we just have to check. Another thing you can do, an extra step is like, I don't know how much we'd want to do this, but if you suspect something is going on, do they have a house on the market? What's going on with that? That would be kind of a clue. If you look at that buyer and then do a title search and see, oh, they have a house on the market, then that would make me think maybe this is contingent, or I would at least ask for more proof to show that it's not contingent and they have the money to purchase without selling their home.
Yeah.
Maybe they're just backfilling. Yeah.
If you're representing a seller and you've got 15 offers, that would be a lot to do on every offer that comes in.
Maybe you just do it on your top 2 or 3,
Yeah, got it. Okay.
Yeah.
Okay. Sounds good. Thank you. This was really helpful.
All right, you guys, I have a 1 o'clock, so you can reach out to me at any time for any questions. I'm stopping the recording and I wish you all a good day.